Welcome to today's webinar. We're going to be talking about technology CapEx and OpEx, budget planning tricks of successful small to medium-sized businesses. So this conversation is about driving revenue while reducing cost and risk. I am Robin Howes, the owner and founder of Certified Nets. We've been in business for 23 years. We work with small to medium-sized businesses that value technology as well as security, and we're a customer service firm that happens to do technology. We're an award-winning managed service and security provider, and we're excited to have this timely conversation with you today. So why is this topic timely? So this year, 2025, is particularly important to look at if we should use operational expenses versus capital expenses. For one, a lot of companies are having to look at if we need to replace a number of computers in our fleet of computers because they have Windows 10, and Windows 10 is going end of life. So the question is, should we purchase outright or should we lease? Another reason why this is timely is Microsoft is also increasing its licenses. So there is some discounting that can be involved if we choose to pay our licenses for a full year upfront versus if we pay them month to month. And then in general, should we try to view everything as a monthly subscription, or should we continue to purchase one-time expenses like we have done in the past? Another number of reasons why this is a timely topic today is because vendors are raising their prices. So as I mentioned, Microsoft is providing some discounts. As I mentioned, Windows 10 is going end of life, but additionally, Windows Server 2016 is also going end of life. It is as of January 2027, so basically the end of 2026. And again, that is potentially a significant purchase for those companies who do rely on a server still. And then lastly, there are some economic concerns that may determine or move us to be making some purchases sooner as opposed to later. So some business owners may be concerned about the potential for tariffs or even a recession. And in general, just increasing pricing and needing to evaluate if it makes more sense to do a one-time expense or monthly subscriptions and do more now and versus less later. So the example we're going to use today as we talk about this topic is we're going to pretend that we need to purchase 13 laptops. We're going to replace 13 older laptops with new Windows 11 laptops. And for this exercise, we're going to make an assumption that each of those laptops costs $2,000. So we're trying to review a one-time investment of $26,000 and determine if we would like to do that or if we would prefer to spread that into a monthly expense, $870 per month for 3 years. And that would be what life would look like if we had a 36-month lease with a $1 buyout. So the math there is that if we were to multiply $870 by 36 months, it would be an expense of $1,320 more than we would have to spend if we didn't use monthly payments. So there is a added cost to being able to spread those payments, but it is not very much. It equates to about 5% in interest in this particular example. And another thing we should keep in mind is even though in this example, we're talking about 13 laptops at $2,000 each, we can put into a lease more than just the laptop itself. So normally people would look at if they need new monitors, if they need a headset, if they need a docking station, keyboard and mouse, even software and labor that may be a part of accomplishing upgrading these machines. So really, it's probably a lot less than 13 laptops that would get us to that same $26,000 investment that we're going to be talking about today. So what is a capital expense or CapEx? A capital expense involves acquiring assets that will be used over an extended period of time. So some examples of a capital expense might be hardware, like a server or a PC. It could be software, like licenses. It could be infrastructure, like building or expanding a data center. From an accounting standpoint, CapEx is recorded as an asset on our balance sheet, and it's depreciated or amortized over its useful life. It's not expensed right away. So using our example of a one-time expense of $26,000, we would generally, since it's a laptop, we would generally view its useful life as about 3 years and expense that evenly over a 3-year period or depreciate it over a 3-year period. The tax implications are that depreciation reduces our taxable income over those 3 years evenly. The benefit of a capital expense is we get full ownership of those 13 laptops right away. So, for example, if in year 2 or year 3, for some reason, we decided, we no longer need 13 laptops, now we only need 3, we could sell those laptops and not have to report to anybody. We own those assets outright, and we can do whatever we want with those assets. The drawback of a capital expense is that there is a significant upfront investment, so it can be less flexible than an operational expense, and we will talk about that next. So when is a capital expenditure beneficial? So a couple of reasons why a capital expenditure may be beneficial is one, making that one-time expense is generally less expensive than spreading the cost over several months. With this example, we talked about how there was interest incurred if you chose to use a monthly payment. We do get to benefit from those improved efficiencies by ordering those new laptops. People have newer equipment, faster equipment, more reliable equipment. So it is adding to our efficiencies and our productivity. And there are tax benefits. So we can depreciate the value of those laptops over an extended period of time. We discussed 3 years, for example, and we can deduct those expenses from our taxable income. So what is an operational expense, or OpEx? Operational expenses cover our day-to-day costs. So generally those are costs to maintain and operate our IT systems and services. Oftentimes those are cloud computing subscriptions like Microsoft or Azure or Amazon Web Services. They can be software maintenance fees or support contracts. It can be utilities. And as we've been discussing, it can also include leases. When we account for operational expenses, they are put on our income statement, and the expenses are incurred as we incur those expenses. So basically, if we have a lease and it's a monthly payment of $870 per month, that's $870 less of profit and therefore less taxable income. So the tax implication is that they're typically fully deductible in the year that they are incurred. And the benefit of an operational expense is that it's predictable, and in some cases it's flexible. So if we think about software licenses, many times as we add a user, that expense goes up. If we reduce a user count, that expense goes down. So we get to benefit from that flexibility on a monthly basis. And the drawback is that the monthly costs can lead to higher costs over time if they are not managed correctly. So in summary, what are some of the benefits of treating things as an operational expense? As I mentioned, they're easier for scaling up and scaling down. We have lower upfront costs and therefore improved cash flow. And our costs are predictable. We don't have those lumpy expenses that we do with capital expenses. Instead, they are spread evenly over time and therefore very predictable.
CapEx and OpEx accounting. A major distinction between these two types of expenses is how they are accounted for on your income statement. These costs can't be fully deducted in the year they're incurred, because CapEx is purchasing assets that have a useful existence beyond the tax year. Instead, they're capitalized and amortized or depreciated over the asset's lifespan, according to their nature. Intangible assets such as know-how are amortized, whereas tangible assets are depreciated according to the useful life of each item. However, operating costs are deductible. This implies that operation expenses may be subtracted from revenue when calculating the company's profit-loss. Most firms are taxed on their profits, therefore any expenditures you take off the top influence your tax liability. CapEx versus OpEx. In terms of income tax, OpEx is generally preferred to CapEx. As a result, rather than purchasing equipment outright, businesses will lease it from a vendor. Because buying hardware is considered CapEx, all of the money paid up front can't be deducted. The cost paid to a vendor for leasing equipment is classed as OpEx, since it is an operational cost, allowing for a full deduction. Deducting expenses lowers taxable income, which is calculated after net earnings are removed. It is also beneficial when it comes to the time value of money. Currently, accessible money is worth more than future cash because of its earning potential. However, if a firm wants to improve its earnings and book value, it may choose to incur a capital expense, while only deducting a little amount of it from the income statement. This will result in a higher net income that can be shown to investors, as well as a greater asset value on the balance sheet.
So in summary, when do we choose a capital expense versus an operational expense? Oftentimes, capital expense is if a business is looking for long-term benefits that contribute to growth, where they want to own their assets, and generally it's a business that's in a more stable industry with more predictable technology life cycles. And an operational expense tends to happen when a business needs more flexibility, more adaptability to a changing market. They want to avoid large upfront investments. It's a business in a rapidly changing industry or with very short technology life cycles. And in either case, it's really based more on the specific needs and goals of the business. And also, it's important just to understand the pros and the cons of each of those expenditure styles so that you can make an informed decision. So now we're going to switch gears and we're going to go back to talking about our Windows 10 machines that we want to upgrade to Windows 11. And how do we figure out how many machines we need to replace? How did we get to that? Oh, we need to replace 13 computers. So oftentimes we'll look at all of the computers that we own. And one of the things we want to think about is the age of those computers. So if we look at some of the older computers that we have, for example, those computers that are more than 4 years old, those are the ones where upgrading them to Windows 11 may not be beneficial. Those machines may not be compatible with Windows 11. They may not have good performance with Windows 11. And basically just because of drivers and the software that we use, even if Windows 11 goes onto them, they may not be very reliable. So one option that we have is replacing them. And then another option that we have is Microsoft has announced that they will provide Microsoft Extended Support. So for a nominal fee of $61 per device, we can get patching for an additional year. So if that 4-year-old machine, if we leave it as Windows 10 and we use it for another year, we've got another year to start to cycle it out or use it as a spare or a low use system. For those machines that are less than 4 years old, so for example, for those even less than 2 years old, we recommend upgrading those to Windows 11. And it's actually kind of odd that they were purchased with Windows 10, but usually those are just fine running as Windows 11. The hardware is compatible and the performance is fine. For those machines between 2 and 4 years old, we need to make sure that they're compatible, and it's really a business decision. Many times it is worthwhile to consider replacing those machines. Once we finalize the number of machines that we're considering replacing, that's when we begin our capital expense versus our operational expense decision making. So, as we have discussed, one option obviously is a one-time expense and purchasing those machines, software, peripherals, whatever is needed outright. Another option is the operational expense, and that's where we're paying monthly. What we have been talking about to date is a dollar buyout 36-month lease, and with this type of arrangement, we pay for those laptops for the first 36 months. Generally, the laptops are purchased with a 3-year warranty, so you're guaranteed to own that laptop for 3 years. At the end of the 36 months, for $1, you then own the laptop outright. So where we expect a laptop to last 3 to 5 years, you still get that 4th year and that 5th year of potential use of that laptop without any additional expense. Another option of a lease is called a fair market value lease, and this is where you don't own the laptops at the end of the 36 months. This is good if you want to trade in those laptops and then get brand new laptops for the next 36 months. So this is almost more like a rental program where you can plan to have nearly the same monthly payment from here to eternity and always get a new computer every 3 years. So no one can predict the economy, and it's definitely not my intent to get political, but there's definitely pressure for increasing pricing. And so when we think about what we want to purchase today, if we want it to be 13 laptops, 2 laptops, whatever the example is for you specifically, we probably want to just do a gut check of what do we think life might look like in a year. Do we want to front load some of those investment in assets and hedge our bets against inflation? Or do we want to do what our normal refresh rate might look like? So it's just a matter of looking at if we want to purchase something sooner as opposed to later. To wrap up and put it very succinctly, some of the advantages to leasing are that we can preserve cash, preserve our working capital, preserve our credit lines. Leases oftentimes are easier to budget. They're very predictable. We can use that cash flow in other areas. We don't have a large one-time expense or down payment. We can hedge against any additional inflation that may be incurred over the next 1, 3, 5 years. And since devices do depreciate over 3 to 5 years, we can build in this refresh cycle if that is a benefit to us. There are 2 different lease structures that we talked about. We talked about the dollar buyout. That's a little closer to a capital expense. We own that equipment outright in year 4 and year 5. Or we could do more of a fair market value, which is more like a rental arrangement where we continue to pay a monthly fee and our equipment is renewed and refreshed every 3 years. All right, that was a lot of information. Let's really narrow it down. So in general, I would say that if you have the cash to pay up front, that is recommended. It costs the least. However, if the cash is not readily available, if it means going into a credit line, or if you have other opportunistic plans for that cash, or if you prefer just predictable expenses over lumpy expenses, those are definitely reasons to lease instead. At Certified Nets, we take budgeting and planning very seriously. Part of the Certified Nets way is no surprises, no financial surprises, as well as no technical surprises. So like clockwork, we meet and we review budgets every quarter. we are looking at the next 6 months to 3 years, and we're having conversations like these about budgeting and planning and technology refreshes and business initiatives that have a financial investment as a component of them. We're talking about them each quarter, and we're making sure that those plans are solidified more than a year in advance. At Certified Nets, we believe in no surprises, no technology surprises, no financial surprises. So I hope you found this webinar helpful in terms of really looking at how we budget and how we invest in technology expenses. And for those of you that have not worked with Certified Nets, we are offering a free executive recommendations meeting to help dig into these items and other items as you look at your next 6 months to 3 years and those technology investments and strategic initiatives that you have. And we will help dive into providing a 3-year budget. Thank you very much.